Today, we're going to talk about some unique features of Universal Life. You'll recall from previous recordings and everything that Universal Life is a very unique product in that it really has a term component, be it YRT or be it level cost of insurance, okay, plus an investment component. So a lot of people refer to Universal Life as buying term and invest the difference, so to speak. So Universal Life, as you remember, is an unbundled product in that you break it up into smaller pieces. Whereas whole life is a bundled product, so as a result, it's very difficult to break that out. So let's say, for example, you received a statement from an insurance company, and it says that you have $50,000 worth of cash sitting in your policy. And let's say for a moment that you had whole life insurance as your product. You take the $50,000, you look at it and say, geez, I really could use $5,000. But you discover that in the only way you can get that $5,000 would be if you can borrow that money. In other words, you can't make an actual withdrawal, so you have to borrow that money. With Universal Life, on the other hand, the nice idea of Universal Life, because it is an unbundled product, is that yes, you can still borrow the money if that's what you wish to do. But instead of borrowing the money, you can also make an actual withdrawal. So really, all you have to do in that case is you get your statements, whatever, simply phone the insurance company, you say, send me $5,000. And they'll send you a check, and that's the end of that. So the withdrawal aspect is a very, very unique feature, only available on Universal Life. It's not available on whole life, participating or non-participating. It is only available on Universal Life. So that withdrawal feature is one of the major reasons why people do like the flexibility of Universal Life. The other features that are available on Universal Life are the death benefit options. In other words, there are a number of different ways of coverage that you could actually get, depending on your particular circumstances and everything. So let's take a look at the four of them. Level, first of all. So if you pass away, let's say again you got $500,000 for the coverage. You pass away, you get $500,000. So level coverage basically means you get the face amount of the policy, no cash value, nothing at all. It's simply the coverage itself. So you've got $500,000. You pass away, you get $500,000. That's the end of that. Okay. The second one, which is probably the most popular one, in fact, most software today actually defaults on this one, is what we call level plus account value. You'll recall, because of the unbundling aspect of Universal Life, is that we have a term component, but we also have an account value, and we have a cash surrender value account, okay? It's the account value that we're talking about here, not the cash surrender value account. It's the account value. So let's say you had that $500,000, but in that Universal Life policy, you also happen to have $50,000 in your account value, and you pass away. Therefore, you get the $500,000 plus the $50,000. So basically what you're doing is you're taking the account value of your policy, that becomes a death benefit as well. Okay, so it gets $500,000 of basic coverage plus the account value, $50,000, so $550,000. And the interesting thing about this as well is that because it is a death benefit, that account value will be paid out as a death benefit, and therefore it will be tax-free as well. Because as you know, death benefits in Canada are in fact tax-free. So this is very, very popular because people do like the idea that they can also get their cash out of the policy should they pass away. The next one is this one here, which is level plus return of premium. And level plus return of premium basically says, okay, once again, level, which is your $500,000. But during the period of time, let's say 10 years, 20 years, whatever the case may be, okay, you passed away during that period of time. But you also paid premiums, obviously, during that period. So let's say, for example, you paid $2,000 a year for 10 years. So you paid out $20,000 during that same period of time, and you passed away. You're going to get your $500,000. Once again, always that level's there. That's your basic coverage, okay? Plus your $20,000 of premium. Some companies will call it cumulative premium, but basically it's the return of whatever premiums that you put into Universal Life. Should you pass away, you will get not only the face amount of the contract, but you'll also get your premiums that all your deposits that you've made. Basically, all of those will be refunded back to you. And once again, because it is a death benefit, the return of the premium, return of deposits, basically will be once again tax-free as well. So it's a very interesting option that many people will take, particularly business people tend to like the return of premium option. The last one is indexed, and the problem with indexing here is that what we got is a situation where the individual basically saying, I know the 500,000 is great and all that, but will it buy me enough 10 years from now? In other words, we go back to this whole question of, you might say, erosion of purchasing power. How do we overcome the erosion of purchasing power? And how you can overcome it, of course, is you buy universal life with an indexed option. Once again, just like that increasing term that we talked about in the previous recording, you'll notice that goes up every year. It's the same thing here. So basically, your $500,000 is increasing according to Consumer Price Index. Again, you can pick a number, 2%, 3%, whatever that case may be. But once again, I alert you to the fact that index option is an expensive option because not only will your coverage increase, but also your premium will increase as well. So you need to make sure that your client is aware that this is not going to be a fixed premium here. It's just going to be a premium that is going to continue on going up and everything. But again, for the individual that says, look, that's not an issue for me. It's more the purchasing power that's the issue. Then really this particular option is exactly what they need. Now, in all cases, these death benefit types, you pick that option at the time of application because they underwrite that to the fullest extent. In other words, we assume that you're going to be using these options forever and a day, basically. So you do need to make that on the application. You actually have to indicate that at that point. So this is not done after the fact. It's done actually during the application because there is underwriting involved in all of this. Okay. So for now, we'll leave it there and we'll see you shortly.